Hi, you're welcome to episode 6 of Make It Count Legal Accounting Made Easy with Benji. My name is Benjamin Elfayado. On our previous episode, we looked at the accounting cycle and the accounting equation, during which we were able to establish what the accounting cycle is and what it entails, its details. Also, we were able to look at what the accounting equation is and what its meaning is. We were subsequently able to establish the effect of transactions, that's various transactions, on the accounting equation. Today, we are looking at an introduction to specifically the statement of financial position, which we have spoken about earlier on. You would recall that in one of our previous episodes, as part of the required financial statements as provided for by Section 127 of Act 992, which is the Companies Act of 2019, there is the statement of financial position. And we're able to explain that it tells of the position or a snapshot of the position of the company at a point in time. And you'd recall that we mentioned the main elements in there are the assets, the liabilities, as well as the capital of the company. Today we'll be looking at it into further detail. So on this episode, by the time we are done, we'll be able to establish what the statement of financial position is in terms of its components, and then we'll also be able to distinguish between current and non-current assets, as well as current and non-current liabilities. Then finally, we'll then draw a relationship between the statement of financial position and the accounting equation. So if we are ready, let's get into it. As mentioned earlier, the statement of financial position gives a snapshot of the position of the company at a point in time. And we mentioned earlier that the main elements that you find in the statement of financial position are the assets of the company, its capital, as well as its liabilities. And we've defined already what an asset is. An asset is an economic resource controlled by the company or business or entity as a result of past events from which use the company expects future economic benefits to flow to it. So those are assets. We're also able to establish what liabilities are, and liabilities are the economic obligation owed by the company to third parties as a result of past transactions, for which reason future economic benefits will be flowing out of the company. So those are liabilities. Then we're able to also establish what the capital or equity of the company is, which is the shareholders' account, which will primarily be made up of the shareholders' initial capital contribution and any other profits that would have inured or losses which would have incurred to the business over its operating period. So that will sit under capital or equity. Now let's look at capital specifically. So when you look on the board, you can tell that under assets, there is non-current assets and there is current assets. There is non-current assets and there is current assets. And we'll explain both. Non-current assets are those assets, the benefits from its use are intended to go beyond one accounting cycle. We've already identified what an accounting cycle is, and we explained that it will typically constitute a 12-month period or 1 calendar year, right? So all the assets that the company is going to have control over and for the use that they are going to have is going to straddle beyond one accounting cycle. Those assets will sit under what we call non-current assets. And I'm sure by now you know what current assets are. So current assets are those assets, the use of which or the benefits thereof the company would expect to inure to it within one accounting cycle or one calendar year. And so it is current because it is going to be within, the benefits are going to be within one calendar year, or can be easily converted to cash within one calendar year. But when it comes to non-current assets, for those, it straddles beyond one calendar year. Let's take the non-current assets and typically the components that you find under it. So, as you can see, there is goodwill. Goodwill is, and as I believe you would understand in plain English terms, a certain intangible benefit to the company by virtue of its reputation. Goodwill is a certain intangible benefit to the company or business as a result of its reputation. But specifically to accounting, it is by virtue of its operations over a certain period of time when it decides to get new shareholders or new investors into the business, aside from the profit or the performance of its operations over the period or even its position, based on the reputation that it would have, there is a certain premium to its value. That additional premium is what we are calling goodwill. And we'll be dealing with goodwill a lot more when we deal with partnership accounts subsequently when it comes to changes in the partnership structure. So that is goodwill. Now let's look at intangible assets. Intangible assets are those assets which are used over or beyond one calendar year, however, cannot be touched or felt. And I'll give you an example to explain that. Think about a software. A company can purchase a software and use it. The software cannot be touched. It cannot be felt. It cannot be held. Rather, it gets to be used. Also think about a license to operate. The license that will be granted a certain business or acquired by a particular business cannot be touched nor felt. Yet, it is an asset to the company which is necessary for its use to gain economic benefits. And so you'd realize that there is intangible assets which benefits inures to the company beyond one calendar year, yet cannot be touched nor felt. So those are intangible assets. Now let's look at property, plant, and equipment. And this property, plant, and equipment is one of the things that get to be felt and touched the most when you engage with any business as an asset. So, for instance, when you go into a particular company, you may meet a building. If it is owned by the business or controlled by the business, a building is part of its property, plant, and equipment. It is part of property. Other types of property, plant, and equipment are furniture and fittings, computer equipment, office equipment, motor vehicles, among others, or even production plants. And so these are the various assets that fit into what we call property, plant, and equipment. These are the tangible assets. Other literature will render it as fixed assets. For these kinds of assets, they are intended to be used by the business to make economic benefits. They are not intended to be rented out or sold to gain economic benefit. They are intended to be used by the business. Having said that, now let's look at investment property. Investment property has a certain nature like property, plant, and equipment. But its main distinguishing feature is that it is not intended to be used by the company. Rather, it is intended to be rented out to make rental income And so that would be primarily the difference between property, plant, and equipment and investment property. So for instance, a business may have a number of machines that it would have bought. Let's say mowing machines. But its primary business is to rent out these mowing machines so that it will make rental income from those mowing machines. Such an item will not be classified as property, plant, and equipment. Rather, it will be classified as an investment property. Also, a company may have real estate. So it may own a number of residential facilities or even commercial facilities that it rents out to make revenue. Those kinds of assets, although it is a building, it is not property, plant, and equipment, but it is investment property because the intention of holding it is not to use, but rather to rent it out to make rental income. So that's investment property. All right. So I hope this is clear. Then there is what we know also as deferred tax assets. And that will be dealt with into further detail. But it's got to do with the difference in the computation of the capital allowance and also depreciation in respect of property, plant, and equipment. But that's a matter we'll deal with subsequently. So these are some of the typical examples of non-current assets. I hope this is clear. Good. Now let's look at current assets. So typically some of the items that you find under current assets would include inventory. What is inventory? Inventory is the stock, is typically described as the stock in trade. The stock in trade. And I would explain that. For a business which is into the sale of goods, a business which is into the sale of goods, the item that it sells, the goods that it sells, is known as inventory. It is known as inventory. So if a business is into trading, so they buy goods and sell, those items that they sell are known as inventory. Or if a business is into manufacturing to sell, the items that they manufacture to sell, they are known as inventory. So that is inventory. And it's a current asset because typically it's expected that within a single accounting year, whatever items are produced get to be sold off for cash. So that's inventory. Now there's trade and other receivables. Let's start with trade receivables. So typically trade receivables result from selling goods or providing services, especially when they have not been paid for yet. So when you sell an item or provide a service on credit, you need to record that item as an asset classified as trade receivables. I hope that is clear. So for instance, if I am into the sale of watches and I've sold 4 watches, each valued at 300 Ghana cedis to a particular customer or different customers on credit, and they are yet to pay for it, I need to recognize trade receivables to the tune of 1,200 Ghana cedis, which is 300 Ghana cedis per unit times the quantity of 4 watches. And that becomes 1,200 Ghana cedis. And that's trade and other receivables. It is receivable because I expect to receive cash for it. I hope that is clear. Great. Now let's look at something we call prepaid expenses or prepayments. Prepaid expenses or prepayments. And I'm sure you'll be wondering, how come something known as an expense is an asset? I would explain why. For instance, if you are to pay for a service in advance or pay for goods in advance, and those services are yet to be rendered to you, or those goods are yet to be supplied to you, you have made a prepayment for the goods or services which are yet to be rendered to you. So ordinarily, it would be a payment for an expense, but that expense or the services or goods in respect of that expense are yet to be provided to you. So you've made an advance payment, all right? And that is why we call it a prepaid expense. And so, for instance, in your company's work, if you are to buy, let's say, prepaid ECG credits, and typically you know that, let's say, in a year, you would spend about 10,000 Ghana cedis on electricity. And then at the beginning of the year, you actually pay out or you buy prepaid credits for about, let's say, about 40,000 Ghana cedis. By the end of the first year, you would have expended only about 10,000 cedis out of that 40,000. The remaining 30,000, which you have prepaid, will need to be recognized as an asset to the tune of 30,000, which is the remainder. I hope that is clear. Similarly, for something like, let's say, rent. So you may have paid for rent in advance to cover, let's say, 4 years as a company. Meanwhile, the annual rent is just about, let's say, 100,000 cedis, but then you've paid 400,000 to the landlord. In the current period, you only expense 100,000 of that 400,000 into your statement of comprehensive income. And then the remaining 300,000, which is a prepayment for the subsequent 3 years, you'd recognize it as an asset, as prepaid expenses. I hope this is clear. Great. Now let's look at some of the very obvious current assets. Bank balances. Bank. And your bank balances are your balances in your bank account. As simply put, your bank balances are your balances in your bank account. As simply put. This is an asset to you because these are economic resources that you control that you intend to use to inure future economic benefits to your business. So there's bank. And once you mention bank, you also mention cash at hand. So cash at hand will be also the cash that you are holding in your till or in your company, all right, that you are holding as cash. Those financial resources that you are holding as cash. So these 5 typically you would find under current assets. And so I hope this is clear. Now let's look at something very important on the flip side, now that we've spoken about assets. So you know that under assets we have non-current assets and we have current assets. And we've explained why the first group is called non-current and the second group is called current. Now let's look at liabilities. For liabilities also we have non-current liabilities and we also have current liabilities. And we'll take a look at each one of them. But before that, let's look at the all-important element that we call capital or equity. Capital or equity. This is the concept of capital. Every dealings with the shareholders would have to flow through the capital or equity component of the statement of financial position. You remember from the accounting equation, we mentioned that capital has to do with the shareholders' contribution. Today we are expanding it to indicate that it will be all of the dealings with the shareholders as far as their commitment to the business is concerned. So typically under equity or capital, you would find what we call the share capital or stated capital. And the stated capital will be the contribution, that's the value of the issued shares of the company to its shareholders as far as the running of the company is concerned. So the value of the issued shares to the shareholders, that will be recorded in here. So that's stated capital. The second thing we would find here is what we call the revaluation reserve. The revaluation reserve. And I would explain what the revaluation reserve is. The revaluation reserve is primarily an account where at any point in time, you would have the book value of certain assets. You would have the book value of certain assets. And the book value of the assets are known or ascertained, if you recall, when we looked at the historical cost concept under the accounting concept. All assets or transactions are recorded at historical cost, all right? Because there's also the presumption of a certain stability in the value, stability of value of these items. However, with the passage of time, the forces of the market, which is demand and supply, interplay, and the market establishes value for these items, which may not necessarily be the same value as the book value. So the difference between the market values at any point in time and the book value becomes the revaluation difference or the valuation difference. That difference could be a gain, in which case the market value is higher than the book value in terms of assets, or a loss, in which case the market value of the asset is lower than the book value of the assets. Whether it is a gain or loss, it will flow into what we call the revaluation reserve. And so that's the purpose of the revaluation reserve. And that is done and kept under equity because these assets, as they sit there, ultimately, it is the shareholders who own the business. And that's why such a revaluation will flow into the equity or capital accounts. That's revaluation reserve. Now let's look at retained earnings. Retained earnings is the account used to hold the accumulation of profits or losses over the various years of operations of the business. I'll take that again. The retained earnings account, which others call the income surplus account, is the account used to hold accumulated profits or losses of the business over its years of operation. And so let's say year one of operation, the business makes a profit after tax of 100,000 Ghana cedis. That 100,000 Ghana cedis will flow into the retained earnings account. At the end of year two, the business makes another profit of 70,000 Ghana cedis. That 70,000 Ghana cedis will flow also into the retained earnings account, by which time at the end of year two, the retained earnings account is going to be what? 170,000, which is the first year's profit of 100,000 plus the second year's profit of 70,000, so 170,000. Then the third year, let's assume the business makes a loss of 30,000 Ghana cedis. Now that loss will also flow into the retained earnings of the business, in which case now, at the end of year three, the retained earnings balance of the company will be 140,000, because it is now going to be what? 100,000 profits for year one plus 70,000 profits for year two minus 30,000 loss for year three. So you understand how the retained earnings account works like. Good. So basically, these elements come together to constitute what we call the equity or capital segment of the statement of financial position. Good. So now we've looked at assets, we've looked at equity, and as I mentioned earlier on, we are now going to be looking at liabilities. Good. Now let's look at liabilities. And like I mentioned with assets, we also have non-current liabilities and current liabilities. And the reason for that categorization is similar to that of assets. Non-current liabilities are those obligations of the company or business which will fall due beyond one accounting cycle, which is they will become due after a year. So they are non-current liabilities. What that means is the business will not have to pay for them within the next accounting cycle or the next accounting year. And as you can imagine, the converse is the case for current liabilities. For current liabilities, those are obligations that will fall due within the next accounting cycle, the next accounting year, or the next 12-month period. So that is the main distinguishing element between non-current liabilities and the current liabilities. Now let's look at typical accounts that will go under non-current liabilities. Let's start with long-term borrowings. Long-term borrowings. So typically a company will go for a loan. When it does go for a loan, the payment terms of the loan will probably be one which is spread over a number of years. All right? For the portion of the loans which are due beyond the immediate first year, that portion is described as long-term loans or long-term borrowings. Let me give an example to make it easier. So the company goes for a loan of, say, 600,000 Ghana cedis from the bank. And per its payment arrangement, it is supposed to be paying that loan over a 5-year period. And in equal installments. What that will tell you is that holding, say, interest accruing on the loan constant. What that means is for every month, the company will have to be making payments of 10,000 Ghana cedis. How did I get that? I just divided 600,000 over the 60-month period, which is 5 years. You know, every year is made up of 12 months. So 12 months times 5 years is 60 months, all right? So for the first 12 months, which is the first year, the company is due to pay 120,000 Ghana cedis to the bank. When you take that 120,000 Ghana cedis to the bank out of the total loan liability of 600,000, you are going to have 480,000, which is due after the first year. So that 480,000, which is due after the first year, is what will be classified as long-term borrowings. I hope that is clear. So I'm sure now you'll be asking, does it mean we have short-term borrowings? Yes, we do have short-term borrowings. And that short-term borrowings is the component of the loan which is due within that 12-month period, which is the 1-year period. And so when we come to current liabilities, you see short-term borrowings, and in that case, it is going to be what? The 120,000. I hope that is clear. Great. Now, there's long-term provisions, but also deferred tax liabilities. Let me talk about deferred tax liabilities first. You remember that under non-current assets, we spoke about deferred tax assets. There can also be deferred tax liabilities, and it depends on whether the tax written down value compared with the book value of the assets that are used in the computation of deferred tax, which one is bigger. So depending on which one is bigger, you will either have a deferred tax asset or a deferred tax liability. But as I did say early on, it is a matter we'll deal with later. So just know that there exists deferred tax assets as a non-current asset, and there is also deferred tax liability, which exists as a non-current liability. We'll deal with that. And now finally, let's deal with long-term provisions under non-current liabilities. Let's start with what a provision is to start with. So provisions are obligations that are recognized for events that are expected to happen in the future but have not yet happened, but then we have evidence currently of their likelihood of happening. I'll take that again. So provisions are obligations that are recognized presently for events that are likely to happen in the future but not yet happened, but then we have evidence presently of their likelihood to happen in the future. I'll give an example. You may have gotten into an arrangement with a client, and the client probably, as a result of a breach in the terms, the client may have triggered a legal process where there's the likelihood of damages being granted in favor of this other party, which is the client, against you. All right? And so you have present evidence, which is the breach that you have gone into as far as the arrangement or agreement is concerned, and the triggering of a legal process, all right, which is the present evidence that you have. And per your own assessment, it is likely the client is going to win the case. But the case has not been won yet by the client. And so you see, the future event, which is the client winning the case, has not yet happened, but you have present evidence of the likelihood of that happening, which is your breach and the legal suit which has been initiated. And so you would make a provision. You make a provision for that liability which is yet to crystallize in the future. So that is what we call provisions. And this is grounded on the accounting concept of prudence, as we dealt with in a previous episode, which speaks to the fact that we need to be realistic in the assessment of our assets and obligations. And so we don't wait for it to crystallize first, but to the extent that we have evidence presently of its occurrence in the future, we need to provide for it. And that's how come we'll have provisions. And provisions, just like borrowings, will have a long-term side to it and a short-term side to it. So if per the assessment of the business, that provision is going to be crystallizing after one accounting year, then, and will become due subsequently, that is after one accounting year, then it will be recognized as a long-term provision. However, if it is one that will crystallize within the immediate accounting year or the immediate 12-month period, then it would have to be recognized as a short-term provision, which we will see when we come to current liabilities. I hope that is clear. Good. So now we can see here that under non-current liabilities, we have what? Long-term borrowings, deferred tax liabilities, as well as long-term provisions. I hope that is clear. Good. Now let's look at current liabilities. Current liabilities. So the first of the items we'll look at is what we call trade and other payables. You would remember trade and other receivables when we looked at current assets. Now under current liabilities, there's trade and other payables, and it's a similar concept. Trade payables arise from acquiring items for trade, which is stock in trade, which is not yet paid for. Items acquired for trade which are not yet paid for. So for instance, if you are a business involved in buying and selling, and you've bought a number of items, that you are yet to pay for, those items will be captured under this account, trade payables. All right? So I hope this is clear. So if you are also a manufacturing company, and let's say you have gone to buy raw materials as part of your production, and you have not yet paid for those raw materials, that would also be captured as part of trade and other payables. I hope that is clear. And there could be those other aspects of other payables. They may not directly be related to trade, but then these are expenses incurred for which you are yet to make payments. So for instance, you went to buy stationery, which is for your office operations, or you bought water, you got water supplied to you, and you've not yet paid for it. Those are also payables. So together with the trade-related payables, the two are brought together, and that's how come we have trade and other payables. I hope that is clear. Now let's look at an item known as accruals. Accruals. And I'm sure you'd remember the concept of accruals when we looked at accounting concepts. And what we did say about accruals are that you do not wait to receive a bill or invoice for a thing that you know you have received a benefit for. So for instance, if you are on a post-paid arrangement when it comes to electricity, and the electricity company has provided you electricity for a particular month, but they are yet to bring you a bill, you need to accrue for that expense that you have incurred, all right? And so how can you, for instance, accrue for that since you've not received the actual bill? And one of the ways you can do that is look at the bill for the previous period, right? Which could form a basis for the value that you accrue for the current period, especially if the bills tend to be of a similar value month after month. But if something special happened during the current month, which required that you expended a bit more in terms of electricity bill, on top of what you incurred last period where you actually have a bill for, you just provide for an additional, let's say, 10% or 20% based on the extent of activity. And then you accrue for that expense. And so accruals there will be all the expenses incurred for which your suppliers are yet to provide you an invoice or a bill to cover. So based on, again, the prudence concept, you need to accrue for those expenses. So that is accruals. Now let's look at short-term provisions. Short-term provisions. And we've discussed short-term provisions. So short-term provisions will find itself here. So will short-term borrowings or loans. Short-term borrowings or loans also find itself here, as we discussed earlier. So these will be some of the current liabilities. Then there is also current income tax. Current income tax. And current income tax will be the liability which would be computed from your current period's performance, which is netting off your tax deductible expenses from your tax assessable incomes and applying the relevant tax rate to them. So that becomes your current income tax liability, which will be recognized here as well. I hope that is clear. Good. And finally, bank overdrafts. What are bank overdrafts? So typically you would have your bank balances, all right, which are all supposed to be having money in them, or at worst, having a zero balance. But in a situation where you have overdrawn your account balance, which means your account has gone into a negative. Your account has gone into a negative. And this may be allowed by the bank as a facility because it allows it as part of short-term financing of your business operations. It allows it as part of short-term financing instead of having to grant you a whole loan with terms to it. A bank overdraft, once you already hold an account with the bank may say, okay, your account balance is, say, 20,000 Ghana cedis. However, you've approached them that you need urgent money to clear some goods from the port. So you need about 100,000 Ghana cedis to do that. The bank would say, I will grant you an overdraft so that you overdraw your account to a certain tune. And so it will allow you to get your account into a negative. So your account could go into a negative 80,000 because you already have 20,000 in there and you have overdrawn an additional 80,000, which together will give you that 100,000 that you require to go and clear your goods. I hope that is clear. Good. So these 6 elements you typically find under current liabilities. And I want us to take a look at something. For all the items that we've looked at, under each of the categories, be it non-current assets, current assets, equity, non-current liabilities, and current liabilities, you'd realize something, that they are ordered in an order of increasing liquidity. And what do I mean by that? That is, with each subsequent item, that subsequent item is more likely to be converted to cash than the previous item. And so when you look at something like non-current assets, how are you going to even convert goodwill into cash? So it is one of the most difficult items to convert to cash. Then you have intangible assets. Unless you are selling off a license or a software, you can't convert it to cash. And because it is intangible, relative to tangible items, it will be considered more difficult to convert to cash. Then you have property, plant, and equipment, which will follow, which when it comes to tangible assets, it is the most difficult to convert to cash because originally it's not even intended to be realized through sale. Its benefits are intended to be realized through use, right? Then there's investment property. Investment property is intended to be rented out or given out in order to earn benefits, all right? So you look at them in terms of the flow, and the ones that appear first are more likely, or let me say, are more difficult to be converted into liquidity or cash. And then the subsequent ones have the less difficulty to be converted to cash. And so this informs why these items are ordered in the way they are ordered. And so you realize we actually even start with non-current assets, which generally are more difficult to be converted to cash because they are intended to go beyond a 1-year period. And then the current assets, which are likely to be more convertible to cash in the current period. Similarly, you see that for the liabilities as well. So that informs how these items are ordered on the statement of financial position. So you'd realize that we have assets as one end, and then we have equity and liabilities at one end. And this brings us to the final thing we need to learn on this episode, the relationship between the statement of financial position and the accounting equation. The accounting equation is given as assets is equal to capital plus liabilities. Assets is equal to capital plus liabilities. When you look at the statement of financial position, you can see that we have assets, which is current and non-current and current assets together. We're having a total of it. And then we have equity and liabilities. And that one too, we have a total of it. In which case, the total assets must be equal to the total equities plus liabilities, which is just a reflection of the accounting equation where assets is equal to capital plus liabilities. So you see, the statement of financial position is just a rendering of the accounting equation in more detail. I'll take that again. The statement of financial position is basically a rendering of the accounting equation in more detail. So I hope now you understand the statement of financial position, its structure, its elements. So do you understand the difference between non-current assets and current assets, as well as non-current liabilities and current liabilities, and the various elements that go under them? And then you would also understand the relationship between the statement of financial position and the accounting equation. Good. That will be all on this episode of Make It Count, Legal Accounting Made Easy with Benji. My name is Benjamin Ofeado. Let's meet on the next one.